Good morning, everyone, and welcome to Energy Action's 2023 Energy Market Update. While we wait for attendees to join, we'll just allow a couple of minutes. I just want to mention that please feel free to use the chat box in this webinar to ask questions. If we're unable to respond at the end of we will respond at the end of this presentation. So I'll make sure that your questions are addressed following the webinar if we don't have time towards the end to address all the questions. Just while we're again waiting for attendees, my name is Scott Easton and I'm the General Manager, Energy Markets here at Energy Action. As a brief background, I've spent the last 25 years within the energy and utilities industry, working for retailers, industry regulators, and large energy consumers. During this time, I've not experienced a more volatile and destabilized period of change, which is primarily associated with the transition from a traditional baseload supplied industry to a growing renewables supplied industry. As a brief outline of today's presentation, I want to draw a distinction between point-in-time procurement or market activities and the timing of procurement. And we'll draw examples, and I'll look specifically at some of the market trends to draw this distinction between a point in time and over time, or market timing. The distinction is necessary because it produces two very different outcomes. Energy Action commits to our customers to achieve the very best price outcome in the market at a point in time. And we do this through maximizing the competitive pressure from retailers during a procurement event, generally via our RFP services or the reverse auction service. By maximizing retailer participation and the competitive nature, we've seen that the outcome from this form of procurement event, as opposed to, let's say, direct offers from a retailer to a customer, are far superior. They produce better price outcome results. This is also because of the volume that we bring to the market of over 2 terawatt hours of energy renewals every year, and the relationship that brings between ourselves and retailers to be able to negotiate improved prices. In order to make this distinction between point in time and market timing, we'll be reviewing 2022 and looking at a number of destabilizing or disruptive influences that have impacted market timing. The key message I'd like to share with the audience today is the point of forward planning and to avoid leaving your procurement activities to the final month or two. We've found that a lot of organizations treat it as a task or a checklist process, where as a contract approaches a month or two before expiry, that some customers look to renew. And we've found that obviously a difference between the point in time of achieving the best outcome available at a point in time and market timing produce very different cost outcomes. And so the key here is to avoid placing yourself in a forced buying position. I'll jump now to our presentation outline, having finished the overview. The purpose of today's presentation is to draw the prelude that I've just described by reviewing the impact of government intervention and how that has affected energy market prices. We'll move then to different approaches or methodologies of how to purchase. Again, these methods differ in the market timing that they provide customers. So in effect, you are choosing a product that allows you more flexibility in terms of market timing. We'll then have a look at the obvious consequences of sustained high prices for businesses and customers. And then we'll jump to what is sometimes a very controversial subject of the role of renewables, the transition, and whether renewables are a cause or solution to market volatility. And again, we'll draw the distinction in terms of timing, as opposed to the short-term or transitional stage, where renewables impact differently to the longer term, where when a critical mass is achieved, there is geographic separation of renewables and the level of supply redundancy is achieved, that will be a different scenario to a short-term transitional outcome. So jumping into the 2022 energy market disruptors, I've compiled a brief list. It's certainly not comprehensive, but some of the key factors that have influenced market timing, that is the point in time at which you come to market to procure energy. And of course, at the top of that list, the war in Ukraine and Russia, which resulted in increased demand for LNG exports and impacted gas prices, which we saw up until a few months ago of over $30 a gigajoule. Clearly, one of the most significant disruptors has been announced decommissioning of coal-fired generation and the replacement of that generation with what's described as intermittent generation capacity. And so that's changed the nature of a market system that was initially designed around a baseload a dispatch model, and of course needs to now accommodate a very different characteristic of generation, which is the intermittent generation. And by intermittency, I'm referring to a plant that is reliant on weather conditions. So the sun shining, such as solar, and the wind blowing, such as wind generation. We've also seen higher levels of generation plant failure and the strategic bidding of baseload generation, which has had a direct impact on market prices. We've seen that generation plant failure, and particularly baseload generation, has been more present in the market, and the reason for that are the investment signals that are created through the eventual decommissioning of that plant. So private companies are unwilling to invest their capital in something that is planned for decommissioning. They're effectively running that asset into the ground. This is a phrase. We've also seen regulators step into the market to try and address what we've all experienced, which is a significant increase in energy prices, and regulators introducing new licensing requirements, launching reviews into bidding behaviours and retailer hedging, and even the ACCC recommending the government implement a domestic gas reservation policy, or DGRP. We also saw the Minister for Resources conclude that gas supplies would be sufficient for 2023 and that it didn't warrant a gas reservation policy, but then followed by the introduction of wholesale price caps on gas and coal. So collectively, these destabilising impacts directly influence your time to market. And of course, if you've left your renewal to the last month or two before your current contract expires, then you find that you're a forced buyer in circumstances where there are unfavourable or destabilising influences within the market, which will impact the cost of your procurement activities. So now moving to the charts, we can see here in New South Wales and Queensland that the price for calendar year 24, 25 and 26 procurement contracts rose significantly over the 2022 period, where we saw prices move from roughly $60 per megawatt hour to over $200 a megawatt hour. And again, this transitional process, the influences that we just looked at in terms of decommissioning, have forced prices significantly higher. On the below chart for Queensland, I've indicated two key points. This first arrow shows when the ACCC announced or recommended to the government that they introduce a domestic gas reservation policy. And we saw the market response, downward movement. That wasn't actioned, and we started to see the market discount the likelihood of that occurring. But then this second arrow shows the effect of the government's introduction of price caps, and namely a $12 a gigajoule price, wholesale price cap on gas, and a $125 price cap on the cost of thermal coal. Clearly, these 2 points were then followed by a significant downtrend in the market. And it's fairly conclusive that government intervention has been successful in reducing prices, where we now find ourselves in a market around $100 per megawatt hour for electricity in Queensland, $120 in New South Wales, and we'll have a look at the other markets on the next slide. What I wanted to point out to the audience is the likelihood of further reforms or disruptions to occur in the market, which will affect the outlook for 2023 prices and beyond. And that is namely market failure that is occurring through the withdrawal of retailers. So in particular within the gas market, where we've seen that price cap of $12 per gigajoule has meant that gas retailers are unable to procure supply to buy contracted gas from producers who are instead preferring to take their chances in the gas spot market rather than lock in to a $12 a gigajoule gas price. The fact that retailers aren't able to source gas means that they have withdrawn or aren't able to offer retail gas. And we would describe this circumstance as a market failure. And it does foreshadow further government intervention to address that. So it is likely that future energy pricing is highly dependent on the form and timing of government intervention. And in the very short term, we're seeing less impact from market forces. Of course, we know that outage and heat conditions and so forth do impact short-term or spot prices, but the significant impact on longer-term prices, or what we refer to as contract prices, that is the prices that you see on the screen here for 24, 25 and 26 calendar year contracts, are going to be more dependent on government intervention as they are market forces. And so the key to reducing your energy purchase costs is forward planning, understanding risk management and the trade-off between risk and cost, and in particular product selection. And I intend in the next couple of slides to walk you through a couple of products that address timing or market timing. They are products that allow more flexibility in terms of choosing when you go to market and really avoiding becoming a forced buyer or avoiding a single point of renewal. We'll get to those shortly. Just quickly before we do, having a look at the Victorian and South Australian market, we can see that current wholesale pricing for 24, 25 and 26 electricity contracts does offer an opportunity to forward contract on current price weakness. We're seeing prices, this is wholesale prices in the market in Victoria, between $70 and $75, South Australia $115 with the exception of 2026, which is trading higher at $140. In New South Wales, that we just looked at, between 120 and 125, and Queensland between 90 and 100. Because obviously no one knows the future, including ourselves, we look to opportunities to secure forward contracting. And just to draw that point out, it would be unwise to forward contract for a long period of time at the peak in the market. But that is a different story at the low or near low in the price cycle. So we can see that energy moves in price cycles, the most recent far more exaggerated than previous price cycles, but that the decision of market timing or when to contract is significantly drawn out by recent events. So we can see that your duration or contract duration, the term over which you contract, will differ depending on the point in time. So we would expect that shorter term contracts, if a customer is forced, as a forced buyer, to enter into a contract at this point in time, you would opt for a shorter term period compared to a point which is significantly lower, where you would look to forward contract for a longer period of time. And we believe that the current market circumstances suggest that 24, 25 and 26 is a opportune. We believe that the current price period presents an opportunity to review those 24, 25 and 26 contracts. Moving on, we're going to take a closer look at the impact that government intervention has had. We've recognised that it has had a significant impact, and we've seen prices drop in response to the government's price caps. So clearly 2022 saw record electricity pricing, which forced the government to intervene and introduce ultimately price cap regulation. This has been effective in reducing electricity prices, although we've seen in the gas market those retailer withdrawal from the market, which has represented a market failure and suggests the likelihood of further intervention. We've seen governments and regulators promote an aggressive approach to transitioning to intermittent generation or renewable generation, state governments supporting the rollout, with the federal government announcing significant investment in infrastructure, and clearly a significant push towards a rapid growth in renewables and a decommissioning or transition away from baseload generation, which has had a destabilising effect. And if I just jump back to our previous charts, we can see that over this period, there has been a change in market circumstances through that transitioning process that has led to higher prices, with the government addressing that through the price cap intervention. We believe that additional government intervention is needed and likely. And we believe that from the reviews that have been conducted, particularly by the AER and ACCC, reviewing opportunistic bidding behaviours, that by not implementing, or the government's choice to not implement, a domestic gas reservation policy, that it was forced to come up with an alternative approach, which was the price capping. I've also drawn a conclusion here in relation to market takeover activity. We can see over the past year that there has been some attempted rationalisation in the retail sector between Origin and AGL with takeover offers, which clearly indicates that there is an undervalued proposition in energy retailing, or that the opportunistic behaviour available by market participants to achieve above average pricing still remains. And it's obvious that clearly a company is taken over because the value that can be extracted is greater than the cost of purchasing that company. I'll move on now. Other impacts that we have seen is the federal government's wholesale price cap, as mentioned, and prices for gas trending back to $10 a gigajoule. So again, the price has declined, but it's unlikely that the price cap in itself or in its entirety is responsible for lower gas prices. We saw a decrease in European demand for our LNG exports, which has meant that supply side improvements or market forces have had a significant impact on monthly average gas prices. So we remember this period, the outset of the Ukraine war, where we saw gas prices increase significantly, which is now followed by a more favourable period of average gas pricing. One unintended consequence, as we briefly mentioned before, is the withdrawal of retailers. We described the reasons for that, and we recognise that there's the potential for further intervention in that market, which is likely again to destabilise the price of gas, and that the price cap in itself may have introduced this market failure, the retailer withdrawal, that may not have occurred. And of course, we're talking in hindsight, but may not have occurred had that price cap not been introduced. Okay, moving quickly now to the different forms of energy purchasing. You recall at the outset, we described point-in-time outcomes as opposed to market timing outcomes. And two products that address that distinction that I want to focus on today is indexed purchasing and progressive purchasing. This chart shows the difference in complexity or the level of customer involvement as opposed to the passive or active approach. And we can see that fixed price contracting, which is a staple and which is very popular, is a set and forget product. You go to market, lock in a price for a fixed term, and as we mentioned, the pitfalls of that is leaving renewal to the last minute and adopting another fixed price, fixed term agreement. So products that improve on that but require more customer participation or effort is an indexed and progressive purchasing methodology. And of course, whilst I'm not focusing on it in this presentation, there are additional types of risk management, such as purchasing through a power purchase agreement or even a renewable supply agreement to assist in your net zero strategies, and even becoming a wholesale market participant. So looking at the two products in particular, firstly at progressive purchasing, we see this is a product that is more suited to larger customers because of the administrative effort and the scale or the size of purchasing required to be able to forward hedge to make a material difference to your purchase costs. So it involves forward purchasing of electricity by quarters rather than by full calendar year. It does avoid a single point of renewal, which we've been talking about, can lead to suboptimal outcomes. And it takes advantage of price changes over time or market volatility, which we've just described in terms of those destabilizing impacts within the market. It is a hedging product, a retail hedging product, where customers purchase at wholesale market prices and have a pre-established retail margin added. So it gives the customer access to wholesale markets. It reduces the risk of becoming a forced buyer by allowing you to purchase over time. And I've just shown a couple of charts here. In this example, we can see that a customer was able to defer purchasing because of the progressive purchase product to purchase at the lower end of the market and average a price of $135 by comparison to the $270 that was prevailing just a month prior to this purchase. You can see that it is a risk management or hedging instrument, and it allows customers, as mentioned, to purchase by quarter. And here's an example of how a forward purchasing strategy shows that over time, a highly contracted or 100% hedged position, and then a hedging process of covering upside risk, but allowing exposure to market prices or variable pricing by leaving a residual to purchase at a later date. This product can also be converted to a fixed price, fixed term agreement by simply closing out at a point in time, closing out all purchases and effectively converting from a progressive instrument to a fixed price or something similar to a vanilla purchase instrument that we talked about before. It's usually conducted over 3 years to allow forward price flexibility. I've shown a couple of years here, but generally a 3-year period is sufficient to allow certainty in the short term for annual budgeting and the opportunity to forward purchase at lower rates. So one observation that we can make is that the closer you are to a consumption period, the higher the price generally is. It's a generalization, but it's an observed fact. And so that's why we encourage customers to avoid leaving renewal or becoming a forced buyer. Success relies on purchasing during price weakness. And of course, the example here shows how that occurs. And it does require the implementation or the additional customer management of formal risk management procedures, such as trading and exposure limits. And it does require quick decision-making to capture or take advantage of short-term price weakness. And that requires a formal delegation or approval process. Okay, jumping to the second product. Again, just reminding the audience that these are products that are able to distinguish between point-in-time renewals and market timing of renewals. And so this product, referred to as indexed purchasing, allows more time over which to purchase rather than a single point of renewal. The product here in this example, we can see that the market price is going up and down, up again and down again. That indexed purchasing allows you to purchase over time or average. It smooths the market. Again, it's dependent on an organization's risk preferences because it doesn't aim to achieve, as we saw in this progressive purchasing, the lowest possible price. It aims to manage the risk associated with high and low prices by taking the midpoint or the index of the market movements. So it removes the risk associated with high price periods, but it doesn't always capture the lowest price. You're taking a midpoint. But the beauty of this product is that it can be a set and forget. It involves lower involvement from customers. You avoid the risk of locking in at the highs of the market, and you have the confidence that you'll achieve the market average price. It specifically targets smaller customers, so that is customers between 500 megawatt hours and 5 gigawatt hours in particular, but it's not limited. There's no upper limit, but it is well suited to this threshold of consumption or annual usage. And again, tracks the market, avoids price shocks. So the situation that we've recently seen, where there have been extremely high prices from the charts that we just looked at, this product smooths or averages. And similarly to progressive, it can be closed out in any point in time to convert to a fixed rate. So for example, if a customer wanted to close out the remaining purchasing, average purchasing over time, you could close out your contract if you believe the market is at a low. It has lower administration and administrative costs. Okay, moving now from the formal method of purchasing to looking at the consequences that we've seen over the past 12 months of high energy prices and the impact that that has had on both consumers and particularly businesses. We've seen increases of between 200% and 300%, depending on time to market and previously contracted rates, but clearly a significant increase in purchase costs for many organisations that did leave their procurement towards the end of the expiry period and found themselves on a steeply rising price curve. We know that that has had a significant impact on businesses, some able to pass on costs, whilst others having to absorb them in their bottom line. We know that this is impacting businesses and their very viability, in particular, manufacturing and other energy-intensive industries. And of course, the consequences of business failure, offshoring, the cost push impact of higher inflation, and of course, the potential for declining domestic demand. So we see the criticality of maintaining low energy prices and actively called on the government to intervene when we saw prices rising to a point that was that had reached records over the past 12 months. Purpose of that is to really just describe that we understand the importance of cost minimisation and the impact that energy costs have on an organisation, and our approach to be able to work with customers through either their choice of a set and forget fixed price, fixed term agreement, or alternatively for larger customers that have the administrative resources to look at alternative methods of procurement. Those methods including the ones that we just discussed, progressive and indexed, as well as power purchase forward purchasing, and even the potential for a customer to enter the wholesale market, or what we refer to as spot pass-through pricing. Okay, I'd like to jump on to the rather controversial and sometimes polarising discussion around renewables and whether they are the cause or the solution to price volatility. And as mentioned at the outset, they are in fact both, depending on your view of timing. And so we recognise the importance that renewable generation has in terms of its contribution to reducing electricity costs in the longer term, but also the contribution it makes to decarbonisation. The debate is focused on shorter term transitioning, where we've seen and discussed in this presentation the impact of announced decommissioning of baseload power generation and its replacement by what is described as intermittent energy that requires firming. So firming is providing a power source, a generation source, when the sun doesn't shine or the wind doesn't blow. And that has traditionally been either baseload generation or gas-fired generation. We've seen over the past 12 months that this has become increasingly costly. And just to quantify that, we've seen the cost of firming renewables, that is replacing renewables generation when the wind isn't blowing or the sun isn't shining, that the firming costs associated with renewables has risen from $20 a megawatt hour to $50 a megawatt hour, or 250% increase over 12 months. And so that is a reflection of the changing nature of our supply mix within the energy market. And it demonstrates one of the attributes as to why prices have been increasing so significantly, and why some forms of generation have a strategic advantage over others. In the transition period, we recognise that gas remains the most critical transition fuel, along with improved battery technology that reduce the costs associated with renewable energy storage. And I'll point very recently to the Albanese government's reconsideration of a gas field off the coast of New South Wales between the Northern Beaches and mid-central coast of New South Wales, where we believe that this is an indicator that the government recognises the, whilst very polarising topical, the importance of a transition fuel from where we were a predominantly baseload generation industry and market design to a higher proportion of renewable electricity. Our conclusion is that after removing the issue of transition timing, that renewables will represent the long-term solution to reducing electricity costs to consumers and industry. But that is a potentially very long transition process, and we estimate that it will last throughout this decade as energy transitions from its currently, the mix is 60% baseload generation, approximately 30 to 35% renewables, and 5 to 10% gas generation. Well, that concludes the content of this presentation. I hope that it's been valuable to the audience, and that if you have heard any information that you would like to explore, in particular, different forms of energy purchasing, and that you have recognised that distinction between point in time and market timing, and that different energy products and different purchasing methodologies provide you that flexibility. We'll jump now to any questions on our chat, and I'll just take a look. Please feel free to send through any questions that you might have. Okay, at this point, I can't see any questions from the audience. So, yes, I will be distributing this. I've just had a comment. Are we able to get a copy of the presentation? Absolutely. As you've seen, I've talked through key concepts, but it would be worth reviewing the detail that I've stepped through in the presentation. So I'll share that presentation with the audience after this webinar. And please feel free, if you do have questions reviewing that, please feel free to send those through. Okay, I've got a question here from David, who has asked, is there a move to time varying pricing, not just peak and off peak, but more differentiated? Okay, that's a great question, David. And looking into the future and some of the reforms that I have been referring to, we do know that capacity mechanisms or dispatch based on plant capacity is an option for the future. It is a characteristic of the WA market, as is a domestic gas reservation policy that currently exists within WA. But what we're saying is that there is a need for further intervention. There is a need for different market structures to evolve, such as a capacity mechanism and the potential for domestic gas reservations for gas. And that we do believe that the market will become more disaggregated, that there will be more delineation, certainly within the wholesale market, that may not, that complexity may not be extended to consumers, but we will see, as David's pointing out, a move to more differentiated or time-based consumption, and clearly one mechanism to do that is a capacity mechanism or form of more discrete pricing. Okay, I've got a question here from Brian. Will pricing get lower? That's a great question, right? One that everyone would love to know. As we, like others, can't see the future, what we do is use these indicators, those indicators that we went through on slide 2 and 3 of this presentation, to look at how they influence forward pricing. And so by using a broker like Energy Action, who is always in the market looking at these influences or impacts that influence price, what we do is form a conclusion from those indicators. And right at this point in time, we indicated that the key influence will be further regulation as opposed to the very short-term influence on price around the traditional use of supply and demand. And so our outlook at this point is very difficult to forecast because it relies on the form and timing of intervention. And so the outlook, we are unable to provide a view on whether prices will move lower or move higher. And of course, that is the key in terms of introducing the concept of risk management. It is, the analogy is placing all your eggs in one basket, but a strategy would be, if you felt that prices were going to drop significantly, that you would defer entering into a forward contract or contract for a very short period of time, as opposed to if you thought prices were going to rise rapidly, that you would forward contract in the near term and for a longer period or a longer duration. What we've been describing in this presentation is instruments or purchasing methodologies that you're able to manage that or manage the risks associated with future price movements. Okay, I've got a question here. Can you please explain why the $12 a gigajoule is not flowing to the benefits of customers or consumers? It's a great question, and it relates to the fact that that $12 cap is a wholesale cap rather than a retail cap. And so what it does is cap the wholesale price that producers offer retailers. It's a good question because it actually demonstrates why retailers have withdrawn from the market. The government chose to regulate the wholesale industry or producers, organisations like Santos and Woodside, companies that explore and produce gas, that they are restricted to a maximum price of $12 per gigajoule to pass on to retailers, with the government's intention that if retailers were purchasing at $12 and applied the usual or historic markup of around $2 a gigajoule, that retailers would be exposed to $14 to $15 energy prices, which was appealing when we were seeing at that point in time, when they introduced the price cap, prices of around or over $30 a gigajoule. It hasn't translated to customers because retailers are actually unable to procure, to contract from producers gas. And so that's why we've seen retailers withdraw from the market. And that's why we have indicated that we expect further intervention in that space. It's obviously a market failure to have retailers or customers not able to contract their gas. And we've seen, unfortunately, customers that have left their contracting late or towards the end of the expiry of their current period, that their only option is to either move to default rates, which are in the order of $40 a gigajoule, or in certain circumstances, depending on size, able to move to a spot contract to procure their gas. And of course, a spot exposes the customer to very different risk aspects, in a very a non-fixed price, if you like. Okay, we've got a question here. What is our view on the outlook for 24 and 25 pricing in New South Wales, specifically coming up to winter? The answer to this, I think we've addressed that at this point in time, it is very difficult to provide an outlook for 24 and 25. We know that current pricing has decreased by over 50% since the peaks, and that warrants a review or an evaluation within your organisation and subject to your organisation's risk preferences, but that it is heavily dependent, as we've discussed, on the political process as to whether prices increase or decrease. Right now, forward pricing is significantly lower than it was over the past 12 months. And I might just jump back to the chart just to demonstrate that forward pricing for electricity for out years 24 and 25. We'll look at New South Wales, and we can see that the forward contracts have dropped significantly. There has been a little bit oversold and a bounce back, but we're starting to see the emergence of a sideways trend in pricing, where the market really, at this point in time, doesn't have any leads in terms of whether it will rise or drop further. Okay, we've got an observation here from Mark. Do electricity prices usually go up during the end of the year? It's a good observation, and generally we see spot markets trend higher towards summer period, and that often does have an influence. The spot price does have an influence over forward pricing. Okay, I'm conscious of time. I know we set a 11:45 deadline, and we're just slightly over that, so I will wrap up. But please be assured that any questions I haven't been able to answer during this presentation, I will get back to you via email. So thanks very much, everyone, for joining us. I hope it's been of value, and we look forward to your contact with Energy Action if you want more information about our products and services. Thanks, everyone. Have a great day.